$847 billion. That's how much U.S. debt China has dumped since 2013, and most Americans have no idea what's happening. Listen, I'm Dalio. I built Bridgewater Associates into the largest hedge fund on the planet, managing over $124 billion in assets. I predicted the 2008 financial crisis. I've studied 500 years of economic cycles across every major empire, and right now, we are witnessing something I've only seen twice before in history. The shift happening between the United States and China isn't just geopolitical posturing, it's a systematic unwinding of the financial architecture that's held your savings, your retirement, and your purchasing power together for 50 years. In the next 18 months, this will reshape everything you think you know about money. I'm going to show you exactly what's coming, the 3 phases this will unfold in, and the 4 specific moves you need to make before the majority wakes up to what's already started. Before I explain what China's doing and why it matters to your money right now, you need to know why I see patterns others miss. In 1982, I made the biggest mistake of my professional life. I went on national television and predicted an imminent depression. I was dead wrong. The market rallied. I lost so much money I had to borrow $4,000 from my father just to keep the lights on at Bridgewater. I had to let everyone go. That failure taught me something critical. Arrogance kills investors. Humility and pattern recognition save them. So I started over. I built a system. I studied every major debt crisis going back to the 1600s. I analyzed the rise and fall of the Dutch Empire, the British Empire, and dozens of reserve currency transitions. I documented the patterns, the stages, the leading indicators. That framework allowed me to see 2008 coming 18 months early. It allowed us to return nearly 14% that year, while the S&P collapsed 37%. And that same framework is screaming at me right now. We are in stage 7 of an 8-stage debt and empire cycle. What China is doing with U.S. Treasuries isn't random, it's calculated, and it's the clearest signal yet that we're approaching stage 8. Let me frame the macro problem so you understand exactly what's unfolding. Since 2013, China has reduced its holdings of U.S. Treasury securities by $847 billion. They've gone from being our largest foreign creditor, holding over $1.3 trillion, to holding just $778 billion as of late 2024. That's a 40% reduction. Japan now holds more of our debt than China does for the first time in 2 decades. This isn't about trade tensions. This isn't about tariffs or politics. This is about something far more structural. China is systematically diversifying away from dollar dependence because they've recognized the same pattern I have. The United States is at the late stage of a long-term debt cycle. Our national debt has crossed $36 trillion. Our deficit spending runs over $2 trillion annually. We're paying over $1 trillion just in interest on that debt every single year. That's more than we spend on defense. That interest cost alone now consumes 23% of all federal tax revenue. History shows that when a reserve currency nation reaches this debt-to-GDP level, when interest costs consume this percentage of revenue, and when the dominant creditor nations begin rotating out of that currency, you're within 5 to 10 years of a monetary regime change. We saw it with Britain in the 1940s. We saw it with the Dutch in the 1700s. The pattern is always the same. The hegemon overextends militarily. The debt compounds beyond productive capacity. Creditor nations lose confidence. They diversify. Then comes the inflection point. China isn't just selling treasuries. They've increased gold reserves for 17 consecutive months as of late 2024.
They're stockpiling commodities. They're building currency swap lines with over 40 countries to settle trade in yuan instead of dollars. They're constructing an alternative financial architecture through BRICS expansion and the Belt and Road Initiative. Russia, Saudi Arabia, Brazil, and the UAE are all moving in the same direction. This is coordinated de-dollarization at a scale and speed we haven't witnessed before. Here's what most analysts miss. This isn't about replacing the dollar overnight. That's not how reserve currency transitions work. It's about reducing dependency incrementally until a tipping point is reached. In 2001, the dollar represented 73% of global central bank reserves. Today, it's 59%. That slide is accelerating. When it crosses below 50%, the psychological and structural implications shift dramatically. Suddenly, the U.S. loses its ability to print money without immediate inflationary consequences. Suddenly, our interest rates must rise to attract buyers for our debt. Suddenly, austerity becomes unavoidable.
Let me make this concrete with a 90-day action plan, because knowing what to do means nothing if you don't implement. This is the exact sequence I'd follow if I were starting today. Month 1 is assessment and preparation. Week 1, calculate your total investable net worth. Exclude your primary residence unless you're willing to sell it. Exclude illiquid assets you can't reposition in the next 12 months. You need a clear number. Week 2, determine your current allocation. How much is in U.S. equities? How much in cash or money market? How much in bonds? How much in real assets? Write it down. Week 3, research custodians for physical gold. I'd look at firms like Bullion Vault for allocated storage or private vaults in Singapore through providers like Silver Bullion or Malka Amic. Week 4, open an international brokerage account if you don't have one. Interactive Brokers allows U.S. citizens to trade foreign exchanges. You'll need this for currency diversification and international equities. Month 2 is initial repositioning. Week 1, purchase your initial gold allocation. Start with 5 to 10% of investable assets. If that's $50,000, you're buying physical or allocated gold and storing it outside the U.S. Don't overthink it. Execute. Week 2, identify 3 to 5 international equities or ETFs with the characteristics I outlined. Look at tickers like RIO for Rio Tinto, BHP for BHP Group, CVE for Cenovus Energy, or broad international funds like VXUS if you want diversification without individual stock risk. Week 3, execute equity purchases. Move 10 to 15% of your portfolio into these positions. Week 4, establish a small position in alternative currencies. Open a multi-currency account or buy a currency ETF like FXF for Swiss franc or FXS for Swedish krona exposure. Start with 5%. Month 3 is farmland and infrastructure. This takes longer because these assets are less liquid, but you need to start the process. Week 1, research farmland investment platforms. Look at Acre Trader or Farm Together if you're an accredited investor. These platforms allow fractional ownership of professionally managed farmland. Week 2, research infrastructure funds. Look at closed-end funds or interval funds like InfraCap Infrastructure Fund or Cohen & Steers Infrastructure Fund. These provide exposure to global infrastructure with inflation protection. Week 3, commit capital to one farmland deal and one infrastructure position. Even if it's $10,000 or $20,000, you've started building that allocation. Week 4, review and rebalance. Look at your total allocation now versus 90 days ago.
You should have moved from a U.S.-centric portfolio to a globally diversified, real asset-heavy portfolio with currency hedges in place. This isn't theory. This is the exact playbook I'd execute today if I were repositioning from scratch. The key is execution in sequence. Don't try to do everything in week 1. You'll get overwhelmed and do nothing. Follow the phases. Build the allocation methodically. Here's what most people miss about transitions like this. The opportunity isn't in predicting the exact moment of Phase 2. The opportunity is in positioning during Phase 1 while assets are still mispriced for the coming reality. Right now, gold is under $4,000 an ounce. Farmland in the Midwest still trades at $4,000 to $7,000 per acre in many regions. International value stocks are trading at 12 to 14 times earnings, while U.S. growth stocks are at 28 times. The mispricing exists because the majority doesn't see the pattern yet. In 18 months, when Phase 2 becomes obvious, when Treasury auctions start failing, when the dollar breaks critical support levels, everyone will rush for the same exits. Gold will be at $6,000. Farmland will be bid up 20%. Currency hedges will be expensive. You'll be buying at the top of the panic instead of the bottom of the denial. I've lived through multiple cycles. I've seen this movie before. The people who preserve wealth aren't the ones who predict the exact day of the crisis. They're the ones who recognize the stage of the cycle and position accordingly while there's still time. We are in the late stage of the largest debt cycle in modern history. China dumping $847 billion in U.S. debt isn't noise, it's the signal. You have a choice right now. You can wait for more confirmation, for more data, for the mainstream media to finally cover this story when it's too late, or you can act on the pattern while the asymmetry is still in your favor. 18 months, that's your window. Use it.